Good afternoon, everybody. This is Jim Kenny for Thursday, the 18th of April, 2019. This is at the closing bell here today prior to the Easter holiday. Again, as I always say, regarding the broadcast, these will be my opinions and my ideas and views, and also that past performance is not necessarily indicative of future results. And short-term trading, option trading, does involve substantial risk of loss, and ergo is not right for everybody. So ask your clearing firm, your financial advisor, and your good common sense what, if any, strategies might be appropriate for you. Again, I'm Jim Kenny, and a quick background. I've been in the investment arena here for decades, and I've done hundreds and hundreds of seminars and webinars throughout the country, and basically educating people on the uses and risks of options and some of the different strategies for cash flow, limited risk speculation, as well as hedging. So again, I do encourage everyone to let others know about the broadcast by telling them to go to optionprofessor.com and get the link each and every week, and also to shoot me an email with any questions you might have that I might be able to help you with. And the email, of course, is optionprofessor@gmail.com. Okay, let's get into it, because as you know, if you've been to the broadcast before, we do go over a lot of information. Let's start out with what happened today. Today, the Dow Jones was up 110. As you can see from the screen there, it did pop down a little bit at the end of the day. And the NASDAQ had a good rally up towards the all-time highs, but kind of faded a little bit, but pretty steady, up about 2 points, not much to write home about. With regards to the news today, the Mueller report came out, redacted version, and obviously they'll be tossing that ball around here, there, and everywhere. More important to me is how's earnings going and what earnings might show. So some of the financials have had some decent earnings, and so the financials have done pretty good. I'm going to go around the horn on the sectors here in a minute, but I just wanted to highlight the fact that that's what I'm zeroing in on right now. What are the revenues doing, and what are the net earnings doing? It seems to me that it's possible, from what I hear and read, that the market may reduce its focus to the stocks that are showing good top line revenue growth and good earnings, and stay away from the ones that are not delivering such. We also had a couple of new issues come out. Zoom and Pinterest came out as well. We'll try to get into that in a minute, but let's talk a little bit about around the horn of what I look at. Obviously, I look at the major indexes right there. The next one I look at is the S&P 500. So let's put that up on the board and have you take a look at it. Okay, on the S&P 500, we've got it closing at 2905. And we'll shoot the chart up a little bit here, and I'll give you a little review on what I've been saying here on this broadcast, and you can take a look at it. Okay, you see we had the big dump there in December. There you go, bang, bang, bang. That's because, according to everybody, the Fed was going to keep hiking, 3 or 4 hikes this year. And, of course, that, along with growth fears around the world, sent everybody to the sideline and dumped everything out. Obviously, when you go down like that, there's a lot of liquidation and shorting. So obviously, the next side of the coin is going to be people coming back in and covering those shorts, which is also buying. Now, when we're tanking, nobody wants to buy, so the market makers can drop the bid as low as they like until the selling dries up. Conversely, when everybody wants in, they raise the offer, and they raise the offer pretty fast. Look how far we went from 2350 here. Let's just get the chart down a little bit. And you'll see we're at 2350 here, and let's take a look at the time frame so you can put that in perspective here. And when the selling dried up and everybody wanted to cover their shorts or buy back in because he changed his tune on what the interest rates are going to do, then bingo, we went from 2350 to 2700 in what, a month? 6 weeks at the most. That's a big move back. So that's a big snapback, and that's what happens when liquidity happens on either side. When the buyers go on holiday, the market makers drop that bid. When the people are trying to get in a panicky way, they raise the offer. So if you look at it, really, we have made progress of what, 350 points in about a month. Then we made progress of about 100 points in the next month. And then we've made progress of about 75 points in the following month. And now we've made progress from that high of only about 60 points, it looks like. So is it running out of steam? Well, the Elliott Wave guys that I was listening to, when we were down here at 2350, they were saying that we were going to go to test the 200-day average, which is 2750. We did that very quick, didn't we? Boom. So that was a great call on their part, saying it's going to go back towards 2750, 2800. Then they raised the price because of the quickness of it, and they can't see any waves to the downside. So we're still in like a wave A, according to some of these guys. And this wave A is pretty much supposed to be going after that all-time high of 2940. Can you see we're close to that 2940? So I don't know if we're going to hit it or maybe surpass it by a little bit. But I think if we do that, I think they're looking for that two-wave down. And that two-wave down could take us at least down to 2800 maybe, or maybe down to 2700 if we get a wave coming down off of this high. What would make me think that it's possible that we could see a rollover in May? Well, sell in May and go away. That's not a popular adage for no reason, right? And April is one of the best months in the stock market as far as how that does each month. So let me show you some of the things that might indicate that we could be near a turning point, an exhaustion. One might be the VIX. So let's take a look at the volatility index, which I watch very closely. If you've heard me before, as I told you in the past, when the VIX is above 25, look out. That's when you can fall into the abyss. What does that mean? That's where you can fall off a cliff, and the VIX can spike up. If in fact it gets above 25, you'll see that here. Watch. Even above 20 gets dangerous, right? But above 20, bam. Above 20, bam. Above 20, farts around a little bit. Above 25, bam. Okay. And then, of course, when you're between, say, 15 and 20, okay, the market tends to be uptrending. When you're under 15, the market has already extended itself and may be at a point where it's overextended. And that's where I think we are right now. Possibly. I don't know. I mean, you're not going to step in front of a freight train. There's no evidence of it turning around, but I would start looking for formations that might indicate it's turning around. This would be the neighborhood between here and 3,000. That would make sense to start looking for formations. Okay, so what do you've got here? You've got the VIX down at 10 here, bam. You got the VIX at about 10, 11, bam. You got the VIX down here even higher at about 13. Good size rally, good size jump in the VIX. If the VIX is going to jump, we're going to roll over. I mean, generally that's the way it works. Okay, as you can see, it hit 12. I think that little tail there, it's possible that could be the low on the VIX, which means the high in the stock market might be close. I would keep an eye on it. And again, you don't step in front of a freight train. You look for a formation you feel comfortable with. You have a risk, shall we say, a risk hedging strategy, possibly. In other words, a stop loss or a long call if you're shorting, or some type of offsetting risk type thing. Now, with regards to, so the VIX is telling me this is not a shocking neighborhood, that the high in this neighborhood could be happening there. Okay. Now, other things have really taken off, and I'll go over a couple of things that I look at. One is the Dow Jones Transports. They've done great, and take a look at it. Now, it hasn't made a 52-week high, but it certainly had a good day today, and it also, but it did give up some of its gains, about 100 points of it. Let's move the screen up here, and I'll give you a little idea of what I'm seeing. Now, if you think the market's at a high point, what you might consider is looking at the covered call strategies or the married put strategies or strategies that have to do with collars. If you don't understand what I'm talking about, or you want more clarity on the strategies, I'm more than happy to help. Professor@gmail.com. What's your question? What's your comment? And then I'll come back to you. Give me some way of contacting you, and I'll come back and we'll discuss your questions. Okay, optionprofessor@gmail.com. But we were up at 11:48, and we close at 10.99. But it's had a big run. CSX and Union Pacific are two of the stocks that have really benefited from the big run up in the transports. Now you can see there's some resistance at 11 grand, and we hit that today, right? Went through it a little bit. And if next week this thing rolls over, that would be an indication of that we could have hit a little bit of a high point. It's possible. And then, of course, you've got the all-time highs up here at 11,623. So we're still 623 points away from the all-time high. Okay. So while this, and then the volume here doesn't look like it's going through the roof. You see the volume down here? So that's not tremendously fabulous. You can see when there's a big extended move to the downside, your volume hits up here. And so, again, we haven't really seen a huge high volume blow off that sometimes accompanies these type of things. So the transports, while very strong, could be hitting some resistance. Keep an eye on that for next week. And then another one would be the Russell, because these guys have been pretty good as far as confirming or denying whether a market move might be happening or not. And here you go on the Russell. Let's get that up there for you. And the Russell is a broad-based index, 2,000 stocks, right? So obviously it's a big net, a lot of fish in that net, and it went down on the day here today. So the Russell is lagging. It looks like a double top here, possibly. If we start taking out 1550 next week, the low today was 1556. We start taking out 1550, and if for whatever reason you take out 1500, then I would really throw caution on the stock market overall, because again, it would be more like what I was saying, where leadership may be much more defined in a smaller number of stocks, the ones that have the top line growth revenue and the ones that have good earnings. That's where the money may flow to. And also out of favor sectors, which I'll get into right now. Again, tech has been a big favorite sector, and healthcare has just been a nightmare. So let's give you a little bit of a idea on what that's been like. People are taking money out of one sector, they may upgrade another, and that might explain why a couple of sectors I'm going to show you are doing better. Okay, now this is United Healthcare. Okay, it was up today. A lot of people want to step in front of it now because it's a little bit oversold, but and that low right there could be a panic low because it was accompanied by very high volume. So it is possible that you could buy it and defend it against 208, which I think was the low yesterday, something like that. Yeah, 208 I think was the low. So obviously people are buying into it. Today it hit 214. So they're buying it at 214, putting a stop under 208, the 52-week low, and they're looking for a bounce back rally. But no one can say that that is not a market that has rolled over a bit. And that kind of selling in this kind of a sector creates cash, and the cash has to go somewhere. So where do you think it might have gone? Well, let's give you a couple of examples where it might have gone. First one's going to be on the financials. Okay. XLF, that's the ETF on the financials. Okay. And obviously, people might be rotating into something that has a little bit, it's not as extended. It hadn't had its run yet. You got a nice possible head and shoulders bottom here. You got the neckline right around that 27. And certainly, if you got above 29, it would be off to the races pretty good. Again, the banks seem to be making money. American Express was up pretty good today on their earnings. So again, the money, it looks like it's going into the financials. And if you want to look at the technical setup, let's look at the moving averages. And I can show you from the moving averages what the financials look like right now. I like to use the moving averages because they're based on time and price, not somebody's opinion, not somebody's forecast. And so you're trying to follow the flow of money. You've got it inverted now. The 50-day average is 26.32, and the 200 days at 26.60. Well, it's almost inverted. Yeah. So if we stay above 26 for a while here, the 50 will get above the 200-day, and that'll be another positive. The volume seems to be not that great, though. So that's another reason why you got to be a little bit careful. And the rally could be fueled by short interest, because look, short interest, 10% of the stock. That's a pretty big number. So there's some short covering going on as well. I don't know if you can trust the financials. They were supposed to be great back in 18. Okay, but look what happened. It went from there all the way down to there, and that's in the ETF. You want to look at stocks like Citigroup that went from 80 something into the 60s. So the bottom line is, and of course, Wells Fargo has been no friend to anybody either. The best of breed, J.P. Morgan has done pretty good, but even they've had some throwbacks from time to time. So the financials is one thing that people have been looking into, and then another one might be the energy area. And so on the energy area here, this is another one that is a broad-based ETF, and it gives you an idea of what's happening on that. Let's take a quick look. Move the chart up here. And as you can see, similar to the financials, again, it has a little bit of a bottom there. Could be a head and shoulder messy one, but the neckline around 70. So if we can get above 70 on this thing, that would be very constructive. And of course, if oil prices are going to go back up to 75, you will probably break up above 70. If oil prices are going to go back into the 50s, then this thing will probably take out 65. Right now, it's in the middle. But at anyway, those would be some of the sectors that maybe people are rotating into because the energy sector does pay pretty good yield as well, as you can see. With regards to other sectors that had been popular, let's take a look at some of them. I'm using some of the Vanguard funds here. This one's called the industrial sector. Okay, and that was doing great, and then of course Boeing and some of the other ones started to do not so great, and that put a little cap on this. I think. Let's go take a look and see if overall it's still hanging up. There it goes, right back on the bicycle. So this is one that's been doing pretty good. This is the industrials sector. And there's ETFs of all types. This is just the Vanguard one I'm referring to. There's many others out there. And the other one would be raw materials, which were doing pretty good for a while. Let's take a look at those. And there you go on it. Okay. And the materials, again, they're stalled out a little bit, but they're very similar chart pattern to the industrials, similar to pattern to the financials. And so, if money is going to rotate, those could be some of the areas that people might rotate into because they haven't had such a big advance yet, and maybe their earnings might be a little bit better than some of the others. Only time will tell. What I did want to do is also go over things that I talk about from time to time, which is where else is things happening, and one of them is in the emerging market sector. So let's take a look at emerging markets. China has really been turning the corner here, having a very big rally, and that's without a deal with America. So, bottom line is emerging markets, they're stalled out a little bit right now. A lot of stuff has had a good rally. So, that's why you got to be a little careful up here. You're not buying it at 38, it's at 40 something. And again, it does look like the trend has turned up. Okay, because the prices are going from the left up to the upper right corner, right? That's always a good thing if you're long. And if there's going to be further growth in the emerging markets, and if the dollar was going to go down, then this could be a very good area to be in. So keep an eye on emerging markets. And the other one is stocks in China. And of course, one of my favorites is always BABA. And BABA, I brought to your attention here in the 130, 140 range earlier. And obviously, it had a very significant run up. And now BABA is up at 186. Now, maybe the easy lifting might be behind you. So let's take a look here. Let's take a look at BABA. Yeah. You see, could run into some problems because look, the 200 to 190 area was a problem before, and we're in the 190 area now. So you got to be a little bit careful that there could be a pullback. But again, the trend looks like it has turned up pretty well. So if you're interested in China, it does seem like BABA is one of the lead dogs over there. And Baidu is another one that people keep a look on as well. And let's just take a look at Baidu. Obviously, there's others. If you have questions on it, again, shoot me an email, optionprofessor@gmail.com. And if you have any specific stocks that you have a question on, again, I can give you my view and my opinion, and then of course you could mix that into all the other opinions you have and see if you can come up with something you feel comfortable with. With regards to Baidu, it was up a little bit today. Again, not much action here. This has not been one of the leaders, obviously, but if it does take out this 185 area, 190 area, that could be something to keep an eye on because it's a very large company over there, and it's one of the more popular stocks over there in China. With regards to other things that are going on, there are earnings coming out, and there are some people who have certain ideas on what companies might benefit from the earnings season. And so I'm going to run down some that I've heard of and see what they look like technically and see what goes on. First one here is UPS. And I'll go through about 10 of them real quick here, and we'll take a look and see if they match up chart wise. Okay, here's UPS. Today it was down a little bit, but let's see what it looks like overall. This is a company that has maybe a new pricing structure coming, I have been told, and that could be interesting. Looks like some resistance at 115, but you can see since it bottomed out in December, it's been climbing. 105 support, and then of course this 110 area might be support as well. So basically keep an eye on UPS. Some people think it might be doing pretty good as far as in the earnings season. Let's turn to the next one here, and it's Rockwell. Rockwell, again, is combining, melting together technology and software. And let's see what it looks like technically, and we'll go from there. Rockwell. Rockwell. Okay. Yeah, Rockwell's on the bicycle here, and it's already had a pretty good run up, but obviously that has turned dramatically since the big drop in December. And as you can see, it looks like it's trying to keep going. There's some resistance up here between 190 and 200, but on a pullback, if you still think the company looks good, that might not be a bad one to keep an eye on. ROK. Next one I've been reading that might have a good time here is Hewlett Packard. Let's take a look if that did anything today. And Hewlett Packard today, and how is it doing? Let's take a look. And today was up a little bit. It pays a pretty good dividend at 270. And there are those who are thinking that it might do well during the season here. And if it can take out 17, that would be very impressive. And if it can't, it could have some resistance up here. So keep an eye on the number 17 there. It's very close to it, obviously, at 1666. Another one out there that people are talking about, some of the consumer stuff, Kellogg's. Let's see what old Kellogg looks like here. And Kellogg is down here at the lower area. So if it gets above 60 here, that would be very helpful. And it does look like it's trying to get going. So you could keep an eye on Kellogg and see what you think about that. Above 60 is not that far away. And it does pay 383 dividend according to my screen. So 383 as yield is not a terrible yield. Another one that is kind of that way is Colgate Palmolive. And let's see what that looks like here. And Colgate Palmolive obviously has been on the bicycle, and there are those who think that the earnings is going to help this company. It's already broken above that, well, it's near that resistance here, but there's a gap over here just under 72. But that seems to be a pretty clear uptrend. Of course, obviously there can be pullbacks, and if they miss earnings, obviously that would be terrible. But people do think that there could be a decent one to keep an eye on as well during this earnings season. Let's turn to another one here, and it's another retailer here, Gap stores. I guess with the consumer out there spending, retail sales today were quite good. The best, I think, in a year or two. Not bad. And Gap is certainly going to be out there selling stuff. So let's see what that looks like here. 20 something dollars a share, 26. And let's see what the chart looks like. Yeah. Well, if you can get above 27, that would be good, powerful stuff, right? One move, two move. And if we can get the third one to get through there, that would be nice. And so keep an eye on that. There could be something there. Again, big retailer. And yeah, since we're in clothing, let me look at Levi Strauss because that came out as a new offering. And some gentleman who is a specialist in valuation, he did believe that the valuation should be 29, and that was trading at 22 at the time. And let's see what it's trading at today. So yeah, it's at 23.24, up 34 cents, up another 35 cents in the aftermarket. And the gentleman who does the valuation is a professor in New York who specializes in trying to evaluate companies. And so his mathematics said 29. So if he's going to be accurate on that, that would be interesting. His information on Lyft said when it was in 70-80, his study, his mathematics told him that Lyft should be more like 59. And so let's see what Lyft's doing and see if that made any sense. It was at 70-80 when he was talking about 59. So let's see what happened to Lyft. Lyft is 58, so he was pretty good there. Went down from 90 almost right down to the area that he's talking about, 55 to 60. So again, let's see if he's halfway accurate on Levi Strauss. That would be interesting. And of course, that's an iconic brand, and that's a whole lot different than some of these other offerings that have been coming out. Okay, so that gives you a little bit of some of the ones. They also thought Twitter might do good, and with all the stuff going on this weekend, and the president probably using it constantly. Certainly get plenty of advertising with the president using Twitter so much. Let's just see what that looks like. That is down 8 cents today. And look, if it gets above 35, 36, there's a lot of open area up there. So you could keep an eye on Twitter as well. A huge gap there up between what, 43 and about 38. So keep an eye on that as well, because again, those some people are thinking that they could benefit from a decent what do they call it? Earnings season. All right. One last one I'm going to give you is AMD. I know a lot of you guys follow the semiconductors. They've been doing very, very well for a while now. And let's just see what AMD looks like here, because some people are definitely thinking that AMD is interesting here. So let's take a look at it. AMD. 27 up a little bit today. And let's just see what it looks like here. I don't want that. Let's get off of that and get over here. Let's get over that. And let's get over to advanced micro devices. Oh, one more time. Okay. All right. So it's obviously if we can get above 30, that would be great. And I'd probably wait for it to get above 30 because obviously it came down and filled the gap. If it gaps down from here, that's going to be no good. And if it gets above 30 here, this thing's been stair stepping higher, so it could keep stair stepping. Gets above 30, I'd be interested in looking at that. That's for sure. Okay. Couple things here in the last 5 minutes or so I'd like to cover. Again, interest rates. Okay. Let's look at the treasury yields because they are not going down lately. They've actually been going up. So let's take a look at the treasury yields, and I'll tell you what I've been telling people for a while. Again, my feeling is that there is a potential problem in the debt market. What's the problem? The problem is $10 trillion in a combination of leverage loans, which by definition you can tell they could be risky, and then high yield or junk bonds, and then triple Bs. And triple Bs are the lowest level of investment grade, to my understanding. So if those and their covenants, meaning what covers them and their ratings, if anything would change there, like the slowing of the economy at all, you could when the problem happens is when you see GDP growth at 1%, then you got to be concerned about the bonds. That's what they tell me. So anyway, you're looking at what do you call it? You're looking at triple Bs. If you go down to double B, all the people who have investment grade mandates in their funds would have to sell those. So you've got all those. You got leverage loans. You got high yield with a lot of leverage, and then you've also got 10 trillion in negative yielding bonds. My view. That's where the problem's going to come from, because if you know anything about bonds, the liquidity on them is not that great sometimes, unless you're talking about a treasury. And then if you have a stampede of redemption into a market that's illiquid to begin with, you could have a real problem. We saw a problem with debt in 2008 with the mortgages, right? Can happen on any debt. And when that happens, it trickles into the whole economy. So if I was out there worrying about something, I'd be worried about where they're going to light the fuse on the debt bubble, because in my view, the debt bubble is obviously there. Anyway, interest rates. Today we're at 256 on the 10-year. It went up to 260. You can see there's resistance at 260. So this could just be a bounce up and rates could come right back down again. That's possible. What's also possible is if you get above 260 and get above 280, that we could go after this 3% area again. Again, we're going to have huge deficits. We have a lot of people working and out there spending money. We have got a lot of people who want the dollar down. If you have the dollar down, if you get the growth that Trump wants, and you have everybody out there spending money to get the growth that Trump wants, I think the likelihood of rates staying down is very low. And my history of high deficits is generally not low interest. So I still think there's a possibility that they get back on the bicycle, the Fed, because they're data dependent. And if the data comes in strong, like Trump wants it to come in strong, then that data doesn't support lower rates, right? And so I would be careful still in the bond market, even though obviously rates have dropped dramatically from 3.25. But like anything else, you saw that in the stock market. Just because it drops way down here doesn't mean it stays down here, right? And anybody who wanted to sell out, they probably did it, right? So there you go. And anybody shorting the market on this drop? You bet there are. So you've got people that are out who might want to come back in. You've got people that are, what do you call it? You've got people that are short the market, who may want to buy, or excuse me, they're long the market, and they have been making money because rates have been dropping. They may want to liquidate. When the rates drop, that means the bond prices are going up. So obviously the bond prices have risen dramatically since 3.25 down to here. People have got a lot of profits in there. And if they all want to take them at the same time, which sometimes happens, you're not going to have a lot of people who want the other side of the trade. And that's how you get the pop. Okay. One last thing here, and it's on the US dollar. Okay. EXY. Just been sitting there, 95, 98, 95, 98, 95, 98. Let's see what it's doing now. 97. So it's back strong. You see it's picking up steam. If this dollar, you got to keep an eye on it, and you got to be patient. This thing's been going sideways for how long? A long time. Look at all that data, right? If it starts breaking under 95 and then 94, I would plan on a significantly lower dollar possibly. And if that's going to happen, then this may enjoy it. And this is your gold miners. if we get the dollar drop, right? If we don't, then it's having a pullback like it is now. But it might be just coming into that gap. We don't know. It might just be coming down to 20 and then go like this. So later in the year, if you see the dollar dropping under 95.94, if you see economic growth picking up significantly, if you see the wage growth and the inflation numbers turning, don't forget about this stuff because it had a pretty good rally from here to here, and now it's having a pullback, and it could be rallies over. That's possible. But if it consolidates here and the fundamentals I just talked about start occurring, I'd keep an eye on this as well. Okay, I did cover quite a bit today, as I always do, and I do want to wish everybody a happy and a safe Easter. What I also want to do is invite you to let your friends and associates know that they can come to the broadcast and get an update. And if you have questions you want to submit for the broadcast, email them over to me at optionprofessor@gmail.com. I'll read the questions. I'll try to cover them during the next broadcast. Also, let them know they can attend by getting the link. Until next Friday, I wish you all the best holiday, the best weekend, and only the best in life. Okay, I'm Jim Kenny signing off. Have a great day, everybody.